This is an analysis from Alpha Business Media.
We're jumping straight into a really complex situation today. The Economic High Wire Act facing Nepal's central bank, the NRB.
It's a situation that goes so much deeper than the public debate about interest rates.
It really does. And the best way to picture it, based on our sources, is to think of the NRB as a tightrope walker.
That's a great metaphor.
On one side, there's this abyss of runaway inflation, and on the other, a chasm of, well, economic stagnation.
Yeah.
And they're just stuck in the middle.
Trying to keep their balance between those two crushing forces.
Exactly. And the core insight we're going to unpack today is that focusing only on the policy rate, it's a dangerous simplification. The real issue is more like clogged financial plumbing, a structural sickness.
It's the perfect frame. We're looking at a classic, painful case of stagflation. You've got inflation that's sticky, it's persistent, while economic growth is just anemic.
A vicious cycle.
It really is,
Yeah.
because the standard cure for one problem makes the other one worse. You ease rates to get growth, and inflation could just take off.
And if you hike rates to fight inflation, you basically guarantee a recession.
And that's why this deep dive shows that simply making money cheaper, monetary easing, it just won't work on its own. It ignores a deep crisis of confidence, these broken risk models at the banks, and the biggest bottleneck of all,
The zombie assets.
the zombie assets, primarily in overvalued real estate, which have locked up trillions of rupees and are starving the productive parts of the economy.
Okay, let's unpack this. Let's start with the pressures on that tightrope walker. What's keeping prices so stubbornly high?
Well, the first thing to understand is that Nepal's inflation is unique. It's not your classic demand pull story.
Meaning the economy isn't overheating from too much spending.
Not at all. Our sources confirm it's a stubborn cost push phenomenon, and it's driven by forces the central bank can't really control with its normal tools.
And the biggest one of those is external, right? The Indian peg.
It's huge. The currency peg with the Indian rupee gives Nepal essential stability, which you can't argue with. But that stability comes at a cost.
You end up importing India's inflation.
You do. When the Reserve Bank of India raises its rates to cool down prices in, say, Mumbai, the NRB in Kathmandu has very little choice but to follow.
Even if Nepal's own economy is slowing down.
It's a matter of financial stability. If the interest rate gap gets too wide, you risk capital flight. Money flows out to India, and that hits your foreign reserves. It really limits their monetary independence.
But it's not all imported. The sources talk about a domestic component to this cost-push inflation that's, frankly, maddening.
The tomato journey.
Yes, tell us about the tomato journey from farm to Kathmandu kitchen.
It's described as a masterclass in, and I love this phrase, value addition through inefficiency.
So the farmer gets very little for it.
Almost nothing, but by the time it gets to you, the consumer, the price is exorbitant. And it's because of this supply chain. It's just layers of politically connected intermediaries, transport syndicate.
And no real infrastructure like cold storage.
Exactly. So each layer adds a huge premium without adding any real value. You see the same thing in construction with, cartels in cement and steel, keeping prices artificially high.
So why can't the NRB just hike rates to fight these prices?
Because the policy rate is a demand-side tool. It's designed to cool down an economy that's running too hot. It can't dismantle a transport syndicate, and it can't build a highway.
So they're firing a powerful weapon, but at the wrong target.
Precisely. What's fascinating here is how these domestic supply problems make a tool as powerful as the interest rate. Well, blunt. You end up just killing investment and growth without actually fixing the high prices.
Which brings us to the other side, that tightrope, the anemic growth and the broken credit mechanism. Everyone's shouting for lower rates, assuming cheap money equals more growth.
But that completely overcooks this crisis of confidence. You have to look at the post-COVID hangover from 2020 and 2021.
That period of really aggressive credit expansion.
Aggressive is the word. The credit to GDP ratio soared past 90%.
Wait, 90%. So the amount loaned out by banks is almost equal to the entire country's annual economic output.
It is. It's a massive amount of leverage. And the key thing is that money didn't go into building factories or long-term productive assets.
It went into speculation.
Overwhelmingly. The stock market, and most importantly, real estate.
And now that bubble has popped, so from a bank's perspective, their willingness to lend has just vanished.
Completely evaporated.
Yeah.
They are staring at a terrifying surge in non-performing loans, NPLs, and these are concentrated in overdrafts, small businesses, and of course, real estate.
So a loan officer isn't going to approve a risky new factory loan no matter how low the central bank sets the rate.
No way. Their priority has shifted from growth to survival. They're trying to fix their balance sheets and avoid risk. Institutional risk aversion has completely taken over.
Here's where it gets really interesting, though. The collateral trap. So much of the lending in Nepal is backed by land. What happens when that market just freezes?
It chokes off everything. I mean, if you're a banker today, you know that the land backing your loans, its real value might be 40, maybe 50% less than what's written on your books.
So they're stuck. If they foreclose, they have to recognize that massive loss immediately, which could be devastating.
Right. But if they don't, they're just carrying a bad loan forever. So they're paralyzed. They won't lend new money against an asset whose value they can't even trust. That uncertainty is a much bigger deal than the policy rate.
And on the other side, the borrower is just as scared.
Of course, most businesses are just trying to survive. They're dealing with a massive debt overhang from that boom. All their cash flow is going just to service old, high-cost loans.
So for them, a rate cut isn't a signal to expand, it's just a little bit of breathing room.
It's pure survival. And even if they wanted to invest, who are they going to sell to? Consumer demand is weak, unemployment is high, there's no incentive to build a new production line if no one is buying.
So it's not a lack of liquidity, the money is there.
The money is there. It's a profound crisis of credit confidence, an unwillingness to lend or borrow for anything productive and long-term.
Which is rooted in this structural sclerosis, bringing us to the two sectors at the heart of it all, real estate and manufacturing.
Let's start with real estate. The sources say that for more than a decade, it stopped being about shelter. It just became the national casino.
A speculative bubble fueled by easy bank credit.
And it diverted a colossal amount of capital. Some estimates say over 60% of all bank credit is tied, one way or another, to real estate, an inherently unproductive asset.
And the consequence of that, of pouring all that capital into land speculation.
Two huge, damaging consequences. First, it made real entrepreneurship almost impossible. The cost of land was just too high for anyone who wanted to start a factory or a school.
And second?
The zombie asset crisis we mentioned. A zombie asset is that half-finished shopping mall you see on the edge of town. Or that plot of land that's overvalued and generates zero income.
And trillions of rupees are trapped in these things.
Trapped. And the banks are playing this game of extend and pretend, refusing to foreclose because they don't want to recognize the loss, so lowering interest rates doesn't fix the zombie.
It just keeps it on life support.
Exactly. It keeps it on life support while it continues to starve the rest of the economy of capital.
Now contrast that with manufacturing, which has been starved for years.
A manufacturer faces a whole web of different risks. Long investment horizons, fierce competition from imports.
And banks always saw lending against a piece of land as simpler, safer. But our sources say it's more than just the cost of credit for manufacturers, isn't it?
Oh, much more. We're talking about exorbitant, unreliable electricity. We're talking rigid labor laws, punishingly high transport costs, and a bureaucratic maze just to get permits.
So a 1-point cut in the interest rate is almost irrelevant.
It's a rounding error if your power costs are double your competitors, and it takes you 2 years to get a permit.
The comparison to Bangladesh in the analysis is fascinating here.
It is. Because their industrial success wasn't built on just cheap money. It was built on deliberate industrial policy.
They did the structural work.
They did. They built functional special economic zones with guaranteed cheap power. They focused on logistics. They made it easy to do business rather than choking it with red tape.
Which points to the real structural flaw then, relying on a bank-centric, collateral-focused system to solve deep infrastructure problems.
That's the heart of it.
So given all this, what are the paths forward for Nepal in the next, say, 1 to 2 years? The analysis lays out 2 scenarios.
Scenario A is the easy way out politically. We'll call it the muddle through. The NRB caves to pressure and goes for aggressive, front-loaded rate cuts.
Trying to shock the system back to life, what happens?
You get a little bump. A superficial, short-lived bit of relief, maybe some more personal loans, car loans. But the fundamental problems, the bad loans, the zombie assets, they're all still there.
And that cheap money doesn't flow into new factories.
It flows right back into speculation. You start inflating the next asset bubble. And because this little boom is all consumption, it's all based on imports.
Which drains your foreign currency reserves.
And puts pressure on the peg. So you waste all your monetary firepower on a temporary sugar rush while inflation stays high because the cartels are still there.
Okay, so what's the alternative? Scenario B, the structural realignment.
This is the hard path. It requires the NRB to hold its nerve,
Mm.
maybe ease rates only very cautiously, and make it clear that their tools are at their limit
So the focus shifts to the government.
entirely. And the first, most painful step is dealing with the zombie assets with an asset management company, a bad bank.
Walk us through that. It sounds like financial surgery.
It is. The AMC, which is government-backed, steps in and buys those big, bad real estate loans from the banks at a realistic discounted price.
So the bank has to take the loss.
They have to finally recognize the loss. Yes, it's painful in the short term, but they get cash immediately, and the bad asset is off their books. It cleans their balance sheet, frees up capital, and allows them to start lending again to healthy businesses.
So you take a controlled hit now for long-term systemic health. What else does the government have to do?
All the things we just talked about. Create a real competitive industrial ecosystem. That means functional SEZs, guaranteed power, and a single window system for permits that actually works.
One with real teeth, where if you don't get an answer in time, the permit is automatically approved?
That's the idea. And finally, the Ministry of Finance has to get serious about its own capital spending, getting those roads and power projects built on time and on budget.
This really raises an important question then. The governor of the central bank is being asked to use a screwdriver to hammer a nail.
A very big nail.
Who needs to step up with the actual hammer?
The analysis is crystal clear on this. The biggest economic decisions facing Nepal won't be made in the NRB's boardroom. They have to be made by the government, with the political will to finally tackle the cartels, the bureaucracy, and that crippling zombie asset crisis.
And that's the core insight. The tightrope walker is exhausted, and the real solutions lie outside their control.
It requires immense political courage.
Now, for a final provocative thought for you, the listener, to take away from this, think beyond just Nepal for a moment.
Reflect on this trade-off between currency pegs and imported inflation.
Right. When a smaller country willingly gives up some of its economic sovereignty, its monetary independence, for the stability of linking to a huge neighbor.
How does it ever regain control over its own domestic destiny without risking the very stability it works so hard to get?
That trade-off between stability and independence is a universal challenge for smaller economies everywhere, and understanding the balance is key.
Absolutely key.
You now have the context to see beyond the headlines and understand the much deeper structural forces at play. Thank you for joining us for this deep dive.